The Bank of England holds rates. Oil swings overnight as President Trump gives himself 2 weeks to decide on the Middle East conflict. Australia's job market remains resilient. New Zealand's growth passes expectations and the Philippines cuts. That's coming up in our 5 Things in 5 Minutes on Friday, June the 20th. Then in our deep dive interview, ANZ Head of FX Research, Mahjabeen Zaman, explains how the US dollar is facing further downside risk this year.
Once there is a loss of confidence, it's really hard to rebuild. But what we have seen, interestingly, in the cycle since April is that the US dollar has basically swapped roles with the euro.
But first in 5 and 5 with ANZ, I'm Alex Tarrant, in for Bernard Hickey. US markets are closed, but oil initially rose over 2.5% overnight as the Israel-Iran conflict intensified. Prices did fall back after US President Donald Trump said he would take up to 2 weeks to decide on whether the US would target Iran due to the chance for negotiation. Meanwhile, the Bank of England kept rates on hold at 4.25% in a split vote. ANZ economist in London, Bansi Madhavani, says the policy tone remained cautious.
The 6 members who voted for no change felt that there was no strong case for further easing at this stage, but the 3 MPC members who voted for a cut noted that evidence from labour market data are pointing to softness and they expect disinflation to continue in the second half. Currently, markets are pricing about 50 basis points of easing from the Bank of England in the rest of the year. However, we are of the view that there is more easing likely and we expect 75 basis points of cuts this year.
At 4 a.m. Sydney Melbourne time, the gold price was down 0.65% at $3,385 an ounce. West Texas Intermediate futures were trading up 0.8% at $75.74 a barrel. The US dollar index was up 0.03%. The Aussie dollar was down 0.57% at 64.72 US cents. And the Kiwi was down another 0.83% at 59.82 US cents. Number 2, Australia's unemployment rate remained at 4.1% as expected in May. That came as employment dropped by 2,000, although the number of people classed as unemployed also fell by 3,000. Here's ANZ economist Maddie Dunk.
We've seen that the unemployment rates averaged just under 4.1% over the June quarter so far versus the RBA's forecast of 4.2%. And if we didn't see any increase in employment in June, you would still see a yearly increase in employment of 2.3%, which is better than what the RBA are forecasting at 2.1%. Admittedly, these aren't huge differences, but they do show a better near-term labour market picture than what the RBA was anticipating in its last forecast round.
Number 3, Maddie says ANZ Research's labour market indicator suggests only a slight lift in the unemployment rate from here.
We do think that the labour market is going to remain reasonably resilient and it is looking a little bit better than what the RBA were expecting in their last forecast round. That's probably not likely to be a huge influence on their decision in July. The factors that are going to weigh on their July decision are more likely related to the global outlook, also what we're seeing on the consumer side with consumer confidence and consumer spending, for example. But at the margins, it does support our call for the RBA to keep rates on hold in July.
Number 4, New Zealand's Q1 GDP beat market and Reserve Bank expectations, rising 0.8%. That was stronger than in December, which was revised down to 0.5%. ANZ senior economist Matthew Galt says the RBNZ will have to balance Q1 strength against already soft Q2 indicators.
They've got stronger Q1 growth than what they had in the forecast, but on the other hand, the timely indicators have been quite weak. We've still got a bit more data to come out before the July OCR review, so particularly the QSBO quarterly survey of business opinion. We'll be watching that closely. The Reserve Bank will be due. We still expect 3 OCR cuts, and we've got them in our forecast for the next 3 meetings.
Number 5, the Philippine Central Bank, the BSP, cut rates as expected by 25 basis points to 5.25%. ANZ economist Arundam Chakraborty says a key focus now is on the nation's weakening currency amid an easing cycle.
If the depreciation continues, the BSP may have to intervene to avoid the pass-through of higher import prices into domestic inflation. The BSP highlighted the need for a more accommodative monetary policy stance and expects to cut rates one more time by 25 basis points to 5%. However, the recent increase in the real interest rate to a 10-year high due to rapidly easing inflation suggests that one rate cut may not be enough. We think the BSP will have to cut rates 2 more times by a total of 50 basis points, bringing the terminal rate to 4.75% in 2025.
Arundam Chakraborty there. Now in our deep dive interview, ANZ head of FX research Mahjabeen Zaman looks at how the US dollar faces further downside risk as it has been losing some of its safe haven status.
Look, on the macro front, we do see that the US data momentum does show little signs of rebounding relative to the rest of the world. So you see a little bit of that US exceptionalism fading, and I think we're going to see that in data in Q3 and Q4, especially on the jobs market side. I think, for example, the Doge cuts that have been implemented would only show in the labor market data come October. So that data is going to return eventually, and then again, that kind of tallies into the two cuts that the Fed is looking to implement over the rest of the year.
And then you've mentioned that the US dollar is losing some of its safe haven status. I guess amid this geopolitical uncertainty we're seeing, first of all, where are we seeing those safe haven flows go? But what has sort of caused the USD to lose some of that safe haven status?
Look, I think it's a function of confidence. And once there is a loss of confidence, it's really hard to rebuild. But what we have seen, interestingly, in this cycle, I guess, since April, is that the US dollar has basically swapped roles with the euro. So euro was traditionally has been a cyclical currency, which moves up and down with risk. And the US tends to be a safe haven currency. But I think with all the policy uncertainty that we have seen in the US and which continues to be in play at least over the next couple of months, I think this will continue to weigh on the dollar, and in turn we have seen the euro turn into more of a safe haven flow, which really means that it has really joined the basket of currencies which tend to do in a risk off environment, which is Japanese yen and Swiss franc.
I guess in the meantime as well, though, there's that correlation between the US dollar and the oil price. So what could that do, I guess, in the short term, particularly with the conflict that we're seeing at the moment?
With the Iran-Israel conflict, look, not to say that oil prices may not rally, but what we have seen so far in the near term is that the rally in oil prices have led to a mild rebound in the dollar, given that oil prices and the dollar tend to move together, given that the US is now a net energy exporter. However, we do believe that the current situation may be a little bit different from previous instances. So we do not expect oil prices to sustain at significantly higher levels, i.e. we don't think there might be oil shock where we see prices sustained at higher levels. So in addition to that, there's also considerable amount of spare capacity available to the market, which should then ease some concerns around supply disruptions and cap the upside to oil prices. So again, given that we don't see a sharp uplift and in market action, what we have also seen is that with oil prices we have seen intraday movements high in the dollar, but price action suggests that any rallies in the dollar tends to be sold.
Did the FOMC's new set of growth, inflation and dot plot projections change your view on the currency at all? Or how have markets reacted and how are you viewing that?
Look, they have basically downgraded their growth forecasts and they have upgraded their inflation forecast, and they've also raised their unemployment forecast. And so this kind of just points to a little bit of that stagflationary environment in terms of how markets are going to react or how data is going to react to the incoming tariffs that's going to hit the US economy over the next weeks and months. And basically this kind of points to the reason why they did not shift from 2 rate cuts that they had in their projections previously to 1 at this stage. And this kind of aligns with our own views where we expect 2 more rate cuts this year, followed by another one in 2026.
Mahjabeen Zaman there. I'm Alex Tarrant, in for Bernard Hickey. That was 5 and 5 with ANZ for Friday, June the 20th. Catch you next week with a review of key China loan rate decisions later today.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.